And our process is specifically designed to seek unique solutions to the myriad of financial issues and challenges that you'll face before, during, and after retirement during your lifetime. And the most important thing to understand is lifetime, statistically, for those males on this call, between 75 and 78. And for you females, it's 80 to 83. Interestingly enough, for those who have attained that age, there's another 10 to 12 years of life expectancy statistically.
Doesn't want to move is another little ding, I don't know,
While retirement may have a myriad of different definitions for us, one thing for certain is the cost of healthcare will continue to rise. And that's going to be for consideration for those folks on today's presentation somewhere over the next 20 to 30 years. So to help us understand and analyze what that means and to provide us with a unique solution, today I have with me Dave Corliss, who's Vice President with Capitas Financial. They're an unbiased, independent financial concern that provides insurance solutions. And today, Dave is going to share with you a unique solution that you may want to consider in how to handle the extraordinary costs associated with long-term care. At the conclusion of today's presentation, we'll have enough time for questions, and we'll have an opportunity to offer to you a complimentary analysis of your current long-term care solution. So with that, let me turn it over to Dave and have him chart the course. Dave?
Thank you, Alan. Good afternoon, everyone. I really appreciate the opportunity to be here with you today. I am going to start by attempting to share my screen so that you can see my presentation. And if you'll bear with me 1 second, I just want to make sure that you all can see that. Al, could you confirm, are you able to see the screen?
Good to go.
All right. So thank you all very much. I enjoy having these conversations. This is a topic that's near and dear to my heart. In my previous life at my previous employer, this is all I spoke about all day, every day was preparing for the risk of a long-term care event and the different steps that you can take. And I think one of the great things that Al and I get to do every day is help educate people and help them understand there are ways that you can address this risk, ways that you may not be familiar with, and or maybe you don't fully understand. I will go ahead and move forward to some slides that are typically overlooked, but there is some information that on these what we call compliance slides that I do want to point out. First of which is, this is built on a life insurance chassis, but this is not designed to be a life insurance focused product. And I'll talk about that more as we get into the presentation. So you can see there's some comments here about how it's not meant to be the primary source of life insurance. I'll also call your attention down here where it says this is a cash indemnity product. And that's an important feature of this particular product. This is only one of several products that are available in the marketplace, but it's a pretty good presentation to give you an understanding of what's available out there. And so with cash indemnity, you don't have to provide receipts on an ongoing basis. You just receive essentially a check in the mail, if you will, once you qualify. So again, we'll talk about that more as we get into the presentation. And then lastly, with these types of products, when the benefits are paid out, it's an acceleration of the death benefit, which will reduce the death benefit and the cash surrender value as they're being used. So again, it's built on an insurance chassis. So we just want to point out a couple of those things. And on this next page, another couple of points that I think that are important is this product is non-cancelable. So what that means is as long as you pay your premiums, Nationwide cannot change the terms of the contract, and that's going to be the case with other carriers as well. So it's important to know that, when you buy this, understand what the premiums are, what the benefits are. So things are not going to change without your knowledge. I want to point out that this is subject to underwriting, right? One of the challenges that we have with this is people come to the realization that they want and need long-term care sometimes when they get some less than favorable news from the doctor. So we have to look at it from an underwriting perspective to see, is this person in good health today, as opposed to someone who may already be experiencing some challenges. So that's something that we need to take into consideration. So with that, I will get into the presentation, and I would encourage you to jot down any questions that you may have. I understand there's a lot of information here. I will try to make it as easy to understand as possible. I certainly don't want to insult anyone's intelligence, but this may not be something that you deal with on a regular basis. So we want to make sure that you walk away informed. This is a client-approved presentation. So Josh, I can certainly send it to you. So if folks want to reach out to you and say, can I get a copy of that? You'll have that to distribute.
That would be perfect.
I think one of the most important things to consider when you're thinking about the risk of needing care down the road is, where is this care going to take place? And as you can see, nationwide, the Nationwide Retirement Institute did a survey back in 2021, and 80% of the people said that they want to be at home. I'm not surprised at that stat at all. In fact, I assumed it would be higher. There's a lot of things to consider when you consider aging in place. Number one, it's just comfortable, right? You know where everything is. You sleep in your bed, you're sitting in your recliner, you're going to your refrigerator to get a snack. You've got your friends and neighbors nearby, so you've got a support network. If you find yourself recovering from some sort of event and you want to take a nap, it's nice to be able to turn off the light, go into your bedroom and take a nap and not have all the background noise of a facility with nursing staff coming in and out and the environmental services folks cleaning the rooms, right? So not a surprise that people want to be at home. And so the products today have really evolved and continue to evolve to make it easier for people to use, for example, at home, or let them use it with the help of family members taking part in their care. So if we think about what is long-term care and where does that happen, by far, the most common type of care is what we call informal care. I would bet most people on this call have either participated in informal care or known someone who was receiving informal care. And that's care in the home by families, family members, friends or neighbors on an informal basis. And that may be because they don't want to be in a facility, they don't need to be in a facility, or their finances are such where that's just not an option. And again, by far, that is the most common setting and type of scenario when it comes to long-term care. Home health care may be care provided on a paid basis by skilled professionals. That could be for things such as personal hygiene, physical therapy, occupational therapy, wound dressing changes, things of that nature, where someone from some sort of entity, like a visiting nurses, for example, might come in and provide that care. And then the third option would be your community care. That could be anything from an assisted living facility, adult daycare. It could be a skilled nursing facility, but it's some sort of setting in the community where the care is being provided either on a ad hoc basis or a temporary basis, for example, the adult daycare, or someone who needs 24/7 care. So that kind of encompasses the types of options in terms of the setting and who's going to provide the care on an ongoing basis. Now, when do we need long-term care? Two of the most common points, if you will, would be, number one, you have a severe cognitive impairment, right? It could be Alzheimer's or some other form of dementia, or it could be when you need assistance with the activities of daily living. And so there are 6 activities of daily living, commonly referred to as ADLs, and that's bathing, dressing, using the toilet, transfer from a chair or a bed, caring for incontinence, or eating. And unfortunately, a lot of people do need help with these things, whether it's, they're not steady on their feet, they have continence control issues, whatever it may be. And when you think about long-term care insurance and what you need in terms of a triggering event where you can start receiving benefits, these are the common triggers. So if you have a severe cognitive impairment and that is certified by a licensed healthcare practitioner, or you need assistance with the activities of daily living for a period of 90 days or longer, certified by a licensed healthcare practitioner, you meet the definition of what's called chronically ill. And those are common definitions amongst long-term care products. So once you get to that point, that's when you are certified chronically ill, and that's when the claims can start. Now, the carriers are going to provide they're going to work with you to provide that certification, whether it's through their own means or through your own personal physician. But that's really where you need to get to in terms of qualifying to receive benefits from the different types of policies available. Now, if we think about the cost, this is the point where people take a deep breath usually, because the cost is not inexpensive. And so you can see that the source of this was the Genworth Cost of Care Survey. So for those of you who may have a pen and paper handy, if you were to go on the internet and do a Google search on Genworth Cost of Care, so Genworth Cost of Care, it'll bring up a website link to this cost of care survey. So you can click on it and you can choose your city and state, and it'll show you the differing levels of care and the cost associated with it, both current, as current as it is. I think it shows 2020 numbers right now. And it gives you the ability to scroll out and go out maybe 15, 20, 25 years in the future, and you can apply different inflation rates. So it really helps in terms of putting a plan together to determine, okay, if I'm 60 years old today or 65, I think I might need care age, I can push that slot 15 years and get a sense for what the cost of care will be for home care, for assisted living, a private nursing home, or a private nursing home. It helps you kind of get some perspective on what the cost may be. And I would tell you that over the past 8 years of long-term care, most people are looking to provide coverage that will cover the cost of home care as much as possible, with the thought that if I cover the cost of the home care, that'll cover a portion of the facility care. And if we think about, how might we use this care down the road, a lot of folks, if not most, start off at home and may end up in a facility toward the end of their care need. So you can see for home health aid in 2022, the median cost nationally is just over $58,000, and that number almost doubles 20 years out. And that's assuming, I'm not sure what the rate is, but the default use on this website is 3%. But it also allows you to show what the inflated rate was year over year over the past year. So it may be substantially higher than 3%. Assisted living, you can see, will be about the same cost, but if you go to a nursing home, you're going to see a substantial increase. Another website, you can look to see are the care costs in different states. There are a lot of great reasons to live here in New England. Cheap healthcare is not one of them. So considering retiring and going to a warmer climate, some of the southern states, for example, will have significantly lower costs. So you can look to see how care in those differing states and cities. So it's a great tool to look at as you're, putting a plan. If you're not working with a financial advisor, you could certainly talk to Al. He'd be more than happy to provide some guidance for you in this arena. Now, some of the misconceptions regarding long-term care. Health insurance does not cover long-term care. Health insurance is really going to cover your more acute needs. So when you go to the emergency room, or when you get admitted for a surgery, or you might find yourself in intensive care, that's where the health insurance is going to come in. Medicare is only going to cover a portion of it, and it'll cover up to 100 days, and it's going to require a 3-day stay and you'd have to be discharged and admitted into a facility within 30 days of discharge. And I want to point out the importance of the up to 100 days. They'll cover up to 100 days if you continue to progress. So they'll cover the first 20 days regardless, but that next 80 days, when you're in the facility, if you're not progressing, they may stop the benefits short of 100 days. Again, if you've got a pen and paper, jot down Medicare and Me, I believe is the name of it. It's a PDF that you can download that talks all about Medicare, all the different aspects of it. It's a great resource to have available as you consider what your plan may be down the road. Medicaid is really just a kind of a last ditch effort, if you will. So this is for folks who don't have a lot in terms of financial resources. And each state's going to have their own guidelines, but generally speaking, you're looking at about $2,000 or less of assets. And when you do go on Medicaid, if you are receiving, for example, Social Security, a certain percentage of that money will need to be paid to the facility on a monthly basis. You'll have to spend down your assets in order to qualify. And they will look back over a 5-year period through literally every financial transaction to see if you have gifted money away or retitled assets, and they will question you on it. So if that's something that you're considering, whether it be for yourself or a loved one, I would keep that in mind. You might want to consult an elder law attorney that could help you with that. There are folks that can help you with the application process. It requires a lot of documentation. I can tell you from personal experience, they're worth their weight in gold. But again, Medicaid, again, that's for folks who don't have a lot of financial resources to cover the cost of care. So things to consider. Number one, do you have the resources, right? And if you've got assets, right, whether that's you've got a pension, you've got Social Security, you might have some annuities, some investments. What do you have? And then, think about if you're not working with a financial advisor or planner, you might want to consider doing that so that you can try to understand what might my living expenses look like moving forward. And if I wanted to pursue a plan like this, which one might be the best based on my individual circumstances, my health, my personal family medical history, my personal situation in terms of my family, are they nearby? So there's a lot of things to weigh whether or not you choose one plan versus another. Do you want your family members to be involved? Some people want no part of that. They do not want to interrupt their children's lives because there might be grandchildren. They want to make sure that their parents are able to go to every single soccer game or basketball game or dance recital. They don't burden. Others, and it might be just based on the way their family's always done it, they might say, absolutely, my kids are going to take care of me. And so if the family or friends are going to be involved, you have to also consider the impact, because I can tell you there will be a financial impact, there will be a physical impact, there will be a psychological and emotional impact. It's a big calling. It's a big challenge. And some folks have to step out of the workforce or significantly reduce their hours. The incidence of physical issues increases when you're an unpaid caregiver. So those are things that need to be considered as well. Where are your kids located? Are your friends and family actually able to take care of you? They might have their own physical limitations. They might have children. We just don't know. So all those things need to be weighed when considering it. And then it comes to, how do we pay the bill? Right? So this is where having a plan gives you more options. And when you have options, it helps make the future unknowns just a little bit more manageable. So when it comes to insurance, the first option that you have is life insurance policies with a long-term care or chronic illness rider. So these are cash value permanent life insurance policies where the primary focus is the death benefit, but they have riders that will allow you to access the death benefit as a living benefit via either a long-term care or chronic illness rider. The difference between the two is long-term care riders can be turned on and turned off. So it can be used for something that might be more episodic in nature. For example, a hip replacement, car accident, something where you're expected to get back on your feet and healthy again. So you could turn it on and turn it off. Whereas historically, the chronic illness riders required a permanence of the condition. Alzheimer's, dementia, ALS, Parkinson's. Now, a lot of the carriers have altered their language to allow it to be turned on and turned off, and that's going to be carrier dependent. But generally speaking, that's the difference between the two. But again, in those life insurance policies with the rider, I refer to the long-term care or chronic illness rider as the, oh, by the way, as opposed to the death benefit being the main event, right? You're buying it for the death benefit, but oh, by the way, if you find yourself needing care at some point in the future, you could tap into that death benefit and receive benefits to offset the cost of your long-term care. The linked benefit products are going to be like this Nationwide CareMatters presentation, that product. So this is a life insurance product, but the focus or the primary reason you would buy this is for long-term care. It does have a death benefit, but in this scenario, the death benefit is more of the, oh, by the way. So you'll buy this and you'll buy a pool of benefits, and that benefit may grow over time if you put an inflation rider on there. And so you'll have access to tax-free dollars to offset the cost of your long-term care. But oh, by the way, should you pass in your sleep like we all hope to, there's a death benefit there, and that money will be paid out to your beneficiaries. And that really helps with people who have a concern about putting a bunch of money into a contract. And what if I never need the care? What if I pass in my sleep? Well, with these type of products, because they're built on a life insurance chassis, there's a death benefit that would be paid out tax-free to your beneficiaries. So it helps mitigate that concern. The last option would be your standalone policies, otherwise known as traditional long-term care. And with traditional long-term care, it's a lot like your car insurance. You're going to pay the premium, usually on an ongoing basis. And if you end up needing care, you're going to be able to access the long-term care benefits. But unlike the first two options, there's not generally a death benefit associated with it. Now, most carriers will offer a rider that you can put on that says, if you pass away prior to reaching age 65, we'll give you a death benefit that will be equal to the premiums that you paid. But once you get past age 65, there won't be a death benefit associated with it. So of the three, the standalone policies will typically have the lower premium. But again, you could be in a situation where you pay into a contract for many years and may not get any benefit from it. But it does allow folks who have limited financial resources to have a plan in place should they find themselves needing care. So now, how are the benefits paid? So now we're on claim and we're ready to start receiving benefits. So depending on the carrier and the product, you may have a product that has what's called a reimbursement benefit or one that has a cash indemnity benefit. So starting with the reimbursement, this is a product that's going to need documentation on an ongoing basis. So it will require bills and receipts to be submitted on a monthly basis. Now, most carriers will allow for the facility or the care providing entity to directly bill them so that you're not stuck in the middle, but you have the option of literally writing the check, paying the bill, getting the receipt, and then submitting it. And that's a decision that you could make down the road when you go on claim. Now, it does list that you have to wait to see what services qualify to see if the insurance carrier will cover that. And while that's true, what I would suggest is every policy is going to require what's called a plan of care. So they're going to outline what type of care would be beneficial for each client. And so as long as the services that and the expenses that you're incurring are within the plan of care, that shouldn't be a problem. If there's ever a question, I think a good rule of thumb would be before you incur the bill, reach out to the insurance carrier and tell them what you're thinking about and ask them, would you accept this as an acceptable expense? And they'll let you know at that point whether or not they would. And if it's something that they would not cover, but you still wanted to do it, you are free to do that and just pay for it out of pocket. With the cash indemnity, you don't need to submit bills on a monthly basis. And that is something that is of great interest to a lot of people because they view it as candidly just a little bit less of a headache. I don't need to check every month. I just know that I'm going to get a set amount of money each month that I can use to offset the cost of the bills. You can elect to receive up to 100% of the monthly benefit, or if you wanted to stretch it out a little bit longer than the benefit duration, you could request less. You can use that without restriction. So if you, it's not going to require the receipt. So when you get the money, if you wanted to pay someone to, plow the driveway on a snowy day like this, or shovel a walk, you could do that, right? So there's no restriction on how you use it. And if you have unused benefits, you can literally just set it aside, because you might have another expense next month that might require a little more money. So it gives you a lot of flexibility in that regard. And so that's one of the decisions that you'll want to consider when you're weighing, if you're going to purchase insurance, which type of product might be the best fit for your individual situation. Now, again, this is a nationwide CareMatters presentation. So with their product, they tout the fact that you've got familiarity, choice, and flexibility when you're purchasing this type of product. And so when we think about familiarity, we talked about being at home, right? There's a lot of familiarity with being at home, and that's very comforting to a lot of people, right? It's just kind of nice to know that you're in your own home and you've got your friends and family nearby that can help you out. You'll have premiums and benefits that you'll always recognize. With these types of contracts, as I mentioned early on, the premiums and the benefits are guaranteed. That's something that in years past, and even currently with traditional long-term care, those policies, a lot of them were built and priced in a time when the actuaries really didn't have a great handle on the study of morbidity in terms of when you might need care. Us in the insurance industry, we've got a pretty good handle on mortality and when people are going to pass, but morbidity is a totally different study. And so the early adopters in this marketplace, in terms of the insurance providers, maybe didn't have quite as good a handle on morbidity. And without getting too technical, they also assumed fairly high, what's called lapse ratios. And what that means in plain English is, if 100 people buy a contract, how many people are going to let their policy lapse where the insurance carrier will never pay a benefit? So lapse ratios may have been a little bit more inflated in the policies of yesteryear, whereas today they have a much better understanding of morbidity as well as how long people are holding on to their contracts. But again, with these, you don't have to worry about rate increases, whereas with those older policies, those clients may be seeing rate increases. And you've got a guaranteed death benefit. So with these types of products, when you get a quote or an illustration, it will show you what the death benefit is year in and year out, as well as what the long-term care benefits would be. So it allows you to do some real planning with real numbers because there's no guesswork. The other nice thing about this specific nationwide product is, let's say I put $75,000 or $100,000 into a contract over a period of years. I'm going to get a pool of benefits that's significantly larger. And even if I use every last dollar of those benefits, I'm still going to have a residual death benefit equal to 20% of my initial face amount. So it's kind of nice to know that even after you get a boatload of value out of it in terms of the long-term care benefits, there's still a death benefit available to you. And when you're considering how to build the contract, right? How am I going to pay for this? There's multiple payment options in terms of how you structure your premiums. And there are different inflation options to help you try to keep up with the rising cost of care. Excuse me. So when we look at the different premium options, this particular product allows you to pay with a single one-time premium. And believe it or not, a lot of people take advantage of that because they may have money sitting in a savings account, checking account, or some other account where they've got money that's just there just in case. Others will choose to stretch it out over 5 years or 10 years. And then depending on your age, you may have the option to pay to age 65. That's typically someone who's a little bit younger, or paid to age 100. So all these they might have restrictions based on your age and how long you can pay. But generally speaking, with this particular product, these are the different options available. So to give you a sense of what the numbers might look like, this particular scenario is a 42-year-old male. He's a non-smoker, and he's got a couples discount. So with these types of products, if you're in a state recognized relationship, traditional marriage, same sex, civil union, domestic partnership, as long as the state recognizes it, the carrier will recognize it and they'll give you better rates. So he's got a couples discount and we're looking at a 6-year benefit duration, and he's going to pay $275 per month in premium, and he's going to pay this out to age 100. Now, if he goes on claim, he'll stop paying, but he'll have this 3% compound inflation. So these contracts, there's different components to it. And so if we think about it in terms of how the watch is built, you've got this initial amount that's a 2-year benefit, and that's $96,286. And that's essentially your initial death benefit of the contract. And then you've got a 4-year extension of benefits rider tacked onto that. And that's an additional $192,571. So if this client were to go on claim at age 80, he would have an initial pool of benefits equal to $311,407. Now, if you're like me and you always like to double check the math, you're going to notice that if you add the 96,286 to the 192,571, it's not going to equal 311,407. I think it's 284 and change. The reason this number is larger is this benefit is paid out over a 6-year benefit duration, and there's a 3%, actually right up here, a 3% compound inflation option. So the benefits are growing by 3% every year. So therefore, the total benefit available, should this client go on claim at age 80 and use all, or day one, and use all 6 years of benefits, he would get $311,407. Now, it's pretty unlikely that someone who's 42 years age and who has passed the underwriting process will go on claim day one, but we have to have a starting point. What's significantly more likely is he might get out to age 80 or 85 and then need care, whether it's just due to a general breakdown in his general health, or maybe he's got a cognitive condition. If he were to go on a claim at age 80 for 6 years in a row, he would expect to receive over $957,000 on a tax-free basis to offset the cost of his care. Now, in this scenario, if he were to use all $957,510 to provide for his care and then passed away, there'd be an additional $19,257 that goes to his beneficiaries. That's that residual death benefit that we referred to earlier. So you can see there can be substantial benefits available depending on the amount of time before you go on claim, the amount of premium going in, and the inflation option that is chosen. And if you look at the different inflation options and the impact, you'll see if there was no inflation in that scenario, his monthly benefit would have only been $58,878 for the life of the contract, and he would only get $423,227 over that 6-year period. Now you can see you can go with 3% simple interest, where when we say simple interest, the 3% is based off the first month's benefit. So let's just make it really easy. If the monthly benefit was $100, the interest would be $3 every single month for the life of the contract. Whereas if we went with compound interest, the first year, after the first full year, the benefit would be $103 per month. And then the next year would be 3% greater than $103, and it would keep compounding like that. So you've got 3% simple, 3% compound, and 5% compound. The more aggressive the inflation option, the lesser the day one monthly benefit will be. And the idea behind that is when you choose an aggressive form of inflation, you're going to give up benefit on the front end, right? When he's 42, there's less of a chance that he's going to go on claim. So you give up on the front end with the hope that you're going to get a significantly larger benefit on the back end. One last option that's available in terms of the inflation is what's referred to as the medical care component of the Consumer Price Index. So this is something where the insurance company will look at the medical care component of this pricing index for a 3-year period, and they'll look at the average of that 3-year period. And they will give a minimum of 2% inflation with a maximum cap of 6%. So it's something where you won't know what the inflation amount is until you've experienced those 3 years and they do the calculation. So for some people, they like it because they feel like inflation will continue to be high in the world of healthcare. And they like the idea of being able to cap out at 6% as opposed to the other options of 3% compound or 5% compound. Other folks would rather go with a known entity where they know exactly what the growth amount will be. So that's just a personal decision based on your own views of that, but just know that that's available. So in terms of flexibility, you can choose the care and the services that you feel are right for you. Now, if you're going to have your family and friends take care of you, it has to be built into the plan of care that informal care is appropriate. So the care provider or the licensed healthcare practitioner would have to note that they feel that that's appropriate. But you could choose to receive care in your home, or you could be in a skilled nursing facility, you could be in adult daycare, you could be in assisted living. It's really your choice. If you never need the care, there's a death benefit, right? So you don't have to worry about the use it or lose it component with this type of product. Depending on the product that you choose, whether it's one of Nationwide's products or another carrier, there may be a return of premium benefit where you put the money in and down the road you say, you know what, I won the lottery yesterday for $80 million. I don't need that long-term care. Please give me back my surrender value. So depending on the product and the carrier, there will be differing levels of surrender value, but just know that's a component of this type of product. And lastly, because it is an indemnity product, again, we eliminate the monthly paperwork. So you don't have to track receipts and submit those on a monthly basis. Because it's a linked benefit, again, it's built on an insurance contract, which means you have an immediate death benefit that's guaranteed, and in this scenario by Nationwide. The LTC benefit is generally tax-free, and they put that footnote in there because if the amount of the benefit surpasses what's called the HIPAA per diem limit, which is the amount that the government says that you can receive on a daily basis to provide for care, and you can receive benefits on a tax-free basis. So the current limit today is $420 a day. So if you exceed $420 a day, you would need to be able to provide a receipt that demonstrates what you paid for a qualified healthcare expense that surpassed that in order for the benefits to be tax-free. If you took an amount over that and you don't have some sort of documentation that states exactly what you paid for, and you were to be audited, it might be viewed as a taxable event. So it's just something to keep into consideration. Most people are not exceeding $12,600 per month for home care, and if they are, they're probably receiving some sort of receipt. There's a tax-free death benefit for your beneficiaries, and there could be some cash value buildup that again you could access. So it really is an asset to you. We talked a lot about the product. We didn't talk a lot about the claims process, and that's where care coordination really comes into play. And so Nationwide and other carriers in the space will offer some degree of care coordination where they will help you understand the claims process. Here's the paperwork that we need to fill out. Here's the next step. Here are care providers in your local area so you can do some research, right? So they'll help you with filing the claim, building that plan of care that is required, and then finding those local services and providing ongoing support. And that ongoing support may be very important for folks who are at home today, but may need to transition to a facility, right? So maybe the children are involved to say, hey, we're at home now, but geez, it's getting to be kind of hard. Who are the facilities local in the area? Who are the facilities that do well with Alzheimer's patients? So maybe they have a gated outdoor seating area because Alzheimer's patients sometimes can tend to wander because they aren't really sure where they are. So you may be looking for a facility that has a hairdresser or some other amenity, and they can help you with that. So there's people to help you through the process, because let's face it, it can be stressful enough. When you see a loved one or a close friend whose health is failing and they need help, there's stress involved. So you don't need the additional stress of, how does this all work? Who do I call? What do I do? There will be people there to help you throughout the process. So again, I can't stress enough the importance of having a plan. Whether that plan be, I'm going to use my own money and stay at home, great. If you've got the financial wherewithal to do that, that is your right. If you have the financial wherewithal, you may want to consider purchasing some sort of insurance where you can leverage that purchasing power up and help use someone else's money, and that someone else being the insurance company. Who's going to be involved in the plan of care? Where do I want to be when I may need to receive that care? These are all questions that are better to be answered up front, and so that you can communicate that with your children, your friends, your family. Identify who's going to be your power of attorney, who's going to be your healthcare proxy. There are, as much as there are children for every conversation, there may be children that you want to be in the driver's seat in terms of making decisions on your behalf. There may be children that maybe you'd rather not be the final decision maker. So these are all things that ought to be considered while you're healthy. And so you've got a plan should you find yourself in a situation where you need some care. So that's all I have in terms of prepared remarks. Al, I'll turn it back to you. I want to thank you all for your time and attention. I'm certainly open to any questions you may have.
Dave, thank you so much for once again an outstanding communication and presentation involving a very, very complex issue. Josh, if I can ask you now to open up the lines, and for folks who have a question, please allow for whomever it is to speak and present their entire question, and we'll do as much as we can to answer. And as I said, I'll also at the conclusion provide you with the contact information for obtaining a complimentary analysis of your current long-term care solution. So Josh?
Yeah, so it might be easier, Dave, if you don't mind, to pause the sharing of the screen. That way we can just see who does have questions. Perfect. So if you do have a question, folks, feel free to unmute and ask, and you can do this hopefully as orderly as possible. But if you have any, this would be the perfect time to ask.
Hello.
Once again, you've done an outstanding job.
John, I
You've
see you
answered
have a
all their
question, sir.
questions.
Yeah. Is it possible to get a list of pre-existing medical conditions that may exclude you from this program?
Yeah, so most of the carriers will provide some sort of listing. However, they typically don't provide that in a consumer-friendly format. So in the financial services community, there are some marketing pieces that are considered for client use and others that are for financial professional use. I believe most of them are for use with financial professionals only, so they don't allow us to just send that out. So I would say that if you had interest and there was a certain condition that you were interested in learning a little bit more about in terms of whether or not you'd be insurable, or if you have a family member or friend who would be insurable, that's where you can work with Al, and he can relay those questions to me, and I can do the research to find out. Some things are pretty straightforward, and others, sometimes we have to go to the carrier and present the question to them and have them get back to us with maybe some additional questions to find out a little bit more about the situation.
So you're saying that that information is not available to the public. It's only available to people who have special financial planning designations, credentials?
Yeah, so it's going to depend on the carrier. I'd have to look to see if any of the carriers have them approved for use with the public.
Well, aren't we principally discussing the nationwide policy that was basically the basis of your presentation?
Right, but depending on everyone's situation. So if you are interested, for example, it may be that the nationwide product is not the best product for what you're looking for. It might be a different product. So I'd have to see based on that, which ones, which carrier would we be looking at? And do they have a client approved version versus one that's not as approved for use with the public? I wish I had a better answer, but that's just the way they do things in this industry, because there's some things that they just don't want people just getting on their own with maybe without a full understanding of some aspect of the conversation.
Okay, thank you.
You're welcome.
I have a question.
Sure.
My partner, she's 71, and we're thinking seriously about a long-term care policy. I have one of my own, so I don't need one. And so I assume that the older you are, more expensive it'll be. Can you comment on that? And then, did I hear correctly that you don't only represent nationwide, that there are other carriers available for consideration?
Yes. So to answer your second question first, yes, I do not just represent nationwide. Neither does Al. Al's an independent financial advisor, and I'm with an independent brokerage agency, which means when I work with folks like Al, I can go to the market and see which one might be the best fit. So Nationwide has asset-based or linked benefit products. Lincoln Nationwide, Lincoln MoneyGuard is another product. There's a company called Securian. So there are different carriers in this space. And then when you look at the permanent life insurance policies with riders, almost every insurance company today has some sort of long-term care or chronic illness rider, because the insurance industry is simply evolving to meet client demand, which is, hey, I know I need the insurance, but boy, this risk of long-term care could be ruinous to my portfolio, everything I've worked towards. So why don't I buy a policy that covers me? God forbid I drop dead tomorrow, but should I need care down the road, I can tap into that. To your first question, the sooner you can get it, generally the better, for a couple reasons. Number one, our health tends to be better the younger we are. Not always the case, but generally speaking, that's how it works. Number two, because this is based on a life insurance chassis, your age does come into consideration when they're doing the calculation. So the older you are, to get the same benefit, it will require more premium. And then lastly, if you're looking to put an inflation rider to drive those benefits up to help you keep up with the rising cost of care, the sooner you buy it, the better, because you have more time for that inflation to work in your favor and drive those benefits up. Now, it doesn't mean that you can't get coverage at age 71. Most carriers will go up to age 75. But again, if you have the ability to get it at a younger age, there's value in doing so if it works with your
And am I assuming correctly that the standalone long-term care policy would be generally less expensive than the one that has the insurance component, life insurance components?
Yes, they usually are, because again, they don't have that death benefit component. And if the person buys it and pays for it for 10 years and passes in their sleep, there won't be any benefit paid out. And so it's generally going to be a lower premium. Now, the one risk that you have with that is the fact that the rates can and usually do go up. I would say that the carriers have a better handle on the pricing today. So while none of us has a crystal ball, and I could never guarantee you this, I wouldn't be surprised if the rate increases on currently issued products maybe aren't quite as drastic as those in the past, just because they have a better knowledge of morbidity. They have a better knowledge of lapse ratios and things like that. And the interest rate environment's a little bit better today, which is not a guarantee that it's going to stay where it is. But all those things may lead to less frequent pricing increases, and maybe not quite as drastic, because some of the carriers, and I've seen letters where they'll say, your policy is going to increase by 83%, or it's going to go up by 112% over a 3-year period. Now, when you're looking in the actual dollars and cents, it may not be as big of a deal. To go from $500 to $1,000, for a lot of people, they can absorb that cost, but the percentage is large. And I'm not minimizing rate increases, especially for folks who may be on fixed income, but sometimes the actual percentage is a little more staggering when you see it on the paper versus the actual dollars and cents. But again, when you're dealing with one of these linked benefit products, you don't have that worry. Contractually, they cannot change the pricing.
I see. So there's no added cost in the future. It's just what you've agreed to initially.
Correct.
Thanks.
Carolyn and Steve?
Question about independent assisted and long-term care facilities, such as Loomis or another facility. You explained how to use the benefits pretty well at home. How does one access the benefits at a community if you were to transition from your home into a long-term care facility?
I'm not sure that I caught all of your questions, so I'm going to repeat back what I think I heard, which was if you were going into a facility, how would you access the benefits of the contract?
Yes.
Okay, so once you meet the definition of chronically ill, so if we think back to that slide where it talked about severe cognitive impairment or the inability to perform 2 of the 6 activities of daily living, it doesn't matter if you're at home or in a facility. Once you get to that point, those are going to be the common triggers. So if you're in a facility, you're probably already at that point, but if you're at home and you get to that point and then transition, if you're on claim at home and you transition, now you're just able to submit a receipt from the facility as opposed to submitting receipts for home care if you had a reimbursement contract. If you're getting an indemnity contract, then you'll just receive that benefit at home. And if you're in a facility, you're going to put that toward the cost of your care on a monthly basis. And you can work with the carrier to have them just send the check directly to the care provider or the facility.
Anybody else? Any other questions? All right. Well, as Al and Dave said, Dave will send me a copy of the presentation from today. So if anybody needs a copy, you have my email address. It's on the invitation that was sent to you all. Feel free to send me an email and I will send you over that.
Josh,
Yes.
I would also like to offer to all of you on this presentation an opportunity to have your analysis or an analysis of your current strategy. Go to www.rms, that's Roger Mary Sam, ANDU, Apple Nancy David umbrella.com. Click on the link Contact Us. Click on the link Schedule an Appointment. We'd be happy to talk to you specifically about your individual situation and discuss possible solutions. And Josh, correct me, did everyone receive our contact information if they want to reach out to us?
I will send that out in an email. So I
Great.
will send an email to all of you with the contact information for Al and the presentation.
Great.
Thank you.
If you just want a consultation about long-term care and not any financial advice otherwise, what's the path to get that?
Same way, Rocco, same way.
Same way? Okay.
Yes.
Thank you.
Excuse me.
All right. Well, I hope that everyone has a great day. Dave, Al, thank you very much for the informative presentation. And again, folks, any questions that pop up, please feel free to give me a call or send me an email. And like I said, I will send an email out to everybody with the contact information for Al and for the presentation itself here. So, gentlemen, thank you once again, and you all enjoy the snowy day.
Thank you.
Thank you,
Have a
Josh.
great day.
Thank you.